Okay, here I'm gonna show you something really different, really simple. Okay, and again, I don't care what charts are up. I think the first chart I had for you was Russell futures. I think this is wheat futures. It doesn't matter. You know, a chart is a chart is a chart. You know, buyers and sellers are going to do the same thing regardless. You know, it just the rate that they do it and how they do it just differs. Something really simple is that not only just get the concept of trend, but give you a little secret. What kind of gets you? I shouldn't say a secret because I can't really put this. You know, this. I mean, it's a very well known thing, but a lot of people overlook the concept of momentum and how to actually. I had showed someone how to use what it was a two fork system, and of course, you know, anyone who's a school of the Andrews, you know, there's a lot of guys. I mean, like I said, this one currency trader, he is the number one in the school of Andrews. I don't know anyone else who, you know, he's a bond and you know and currencies, and I don't know anyone else who is adept at Andrews trading as he is. He is the, you know, I mean, just an encyclopedia of information about action reaction and pitchforks. But the thing is just the very simple concept of trend and momentum. I mean, really, so you can see it right in front of you. And I use when I was using forks, I would use it a lot by using the five, you know, the 5 points or the pivots. A lot of folks, of course, you know, folks say, okay, what's the trend? Higher highs or uptrend? Higher highs, higher lows. I mean, higher lows. What's the downtrend? Lower highs, lower lows. In other words, you know, there's higher highs and higher lows. There's a low right there. There's a higher low. There's a higher low. So of course, in this section right here, this section, let me go ahead and circle it, make it a lot easier. This was an uptrend. In this particular section right there, of course. Let me just clean this up a little bit and make it a little better defined. You know, this is very simple. Of course, there's higher lows. You know, the lows are getting high. There's a higher low right there, higher low right there, and it didn't become a downtrend where a lot of folks won't take it until here because you have a lower low. Here you have higher highs. The highs are getting high, and then all of a sudden they get all the way up here, and then you have a lower high. So of course, you know, folks will say, well, that's, you know, it's going, you know, it's a downtrend. Something so easy it hurts, and this is it has to do with the forces. It literally, I've been, you know, being into physics because I've been in physics. I remember when I was a kid, I was into physics a lot, and physics doesn't just stop, you know, in the material world or the physical world. You also have those same concepts, even like I said, within relationships, nature. You have those concepts even in emotion, psychology. There is a physics of psychology. Okay, you see it, and look at the internet conversations that happen on you know social networking. That in and of itself, you're seeing physics in its purest form. Even though it's not the material of the physical world, it still exists. I guess it is physical because you know you have emotions and you have psychology. So there really is a physics in you know in that realm. You have certain forces. You have, you know, of course, the for and you know I'm getting a little bit, you know, giving a little bit away on how I developed Zumbi, but this is just something that really made sense, and to how to, you know, develop and find momentum of a trend. I can't give it to you. You know, I can't say it's secret. I could just say it's my own. Like I said, it's my grail. But here's a little hint. Here's a little simple. It's something that makes it just real easy to real, you know, to kind of. It makes it easier to trade it. You know, losses and all. It doesn't matter. It just made it easier to develop this. You have a low right here, right? And you have a low right here. And I said, well, what consists of a low? And you know, market makers will tell you this in a heartbeat. You know, the price didn't go, it didn't get any further down. You know, folks were, you know, buyers came in. A lot of the supply and demand guys will say, well, there's a lot of supply, and I don't care how you quantify it. Bottom line is, this is a low because nobody else sold it lower than this at this present time. And until then somebody else comes in and says, I'll sell it lower than that, then of course you'll have a new low. Simple as that. Okay, you can't get any simpler than that. You know, I mean, it's like, you know, if you get a higher low, hey, nobody sold it lower than this after this until someone came in after that. And that way, that is your next higher low. You know, when this one came in right here, then all of a sudden it was a lower low. That means that all the folks that said it's going up here it just nullified it right here. They said that this is the low. This is we're standing on our ground. As soon as it got there, hey, it just knocked it out the ballpark. It said no way. We're gonna change all the everything changes at this point. Sorry. So I mean that's just a very simple concept. And this concept, by developing this, and this is what I call momentum. And I mean, it's very simple. Actually, I shouldn't call it momentum yet because I'm not putting my lines in there. And you'll see it when you see this. Well, actually, no, I can't do it. Sorry. I just give you the concept. If you're going here and you got this low, and nobody else sold the market underneath that, until somebody sells the market underneath this, of course, you have until you get a new low. So the market goes up. You're making higher lows. It means more people think, hey, I'd like to buy it at a higher point. This. Say you bought something from the store and you said, hey, this is cool. I'm going to buy it from here, and somebody buys it at a higher point. Then of course, that means that hey, it's nobody's going to sell it underneath here. You have a higher low, and you got new buyers stepping in. Okay, because right here you had a high. Nobody bought the market after this at this point in time. No one. It's like, hey, this is it. This is it ain't going to. And then all of a sudden, you had new buyers come in, and nobody sold the market once this was here. Of course, they say it made a higher high after this because more people sold it at a higher point. Nobody bought after this point. So it's just real simple of just buyers and sellers, buyers and sellers. So I said, well, how do I quantify momentum? It's a very simple way of just looking at momentum of trend lines. Say, for instance, you've got stairs, and you're walking. It goes from here to here. And this, I remember when I was over at the what they call the Great Wall of China, that wall, and I saw the stairs. At one point, the stairs were some of the wildest looking stairs. Some of them were 2 feet wide and like 4 or 5 inches, not even 5 inches, about 2 inches high, and maybe 6 feet back, and then the next stair was like a foot and a half high, and probably had like 4 inches of depth, and maybe it was maybe 3 feet wide. I mean, it was just real. So I started thinking about stairs, and you don't have to think like 'cause there's momentum. Like I said, the concepts of physics are in everything: relationships, emotions, health, weather, you name it. It's in everything. Momentum is just very simple. And I'll get into like certain on how to look at like this is what helps me develop because like I say, most of my methodologies are like either two trend lines and or what I do is I'll map the market out with my median line, and I said that one median line, okay, not pitchfork in the middle, my median line. Okay, I map it out and I'll say, okay, these are the projected, maybe the next projected point or next projected 2 or 3 points, and I'll just wait for my two trend lines to show me my divergence. And I'm not changing this because it's just too accurate. It's too good. I just and I've been using I've been looking at this from charts, not only just back testing, but forward testing, if you want to call it. I don't care if it's a Fed funds rate, rough rice, the euro dollar futures, or the Japanese yen currency. All markets exhibit this, okay? Because you have buyers and sellers. You've got people that said, I ain't buying no more, and I ain't selling no more under this, or I'm not buying over that. The concepts of physics work in everything. Okay, it just doesn't matter. No matter the instrument, whether it's a bond, a mutual fund, it just doesn't matter. It all happens because buyers have to sell to make money, and sellers have to buy. You buy a car, and you want to make money off that car, you got to sell it to somebody who wants to buy it from you at a higher rate. Okay, it's that simple. I'll give you a little preview of how I look at market profile. There's a certain way that if those who are profile traders that you can actually trade market profile without even having to buy those expensive packages. It shows up on your chart right in front of your face every time. So therefore, if you're a range trader or you like to trade, you got to think of the concept. Like I like to use animals. Think of animals in a lake. And the folks that used to go to the Hotep Traders over on the Garvey site, you can actually tell what I used to show you about how the alligators are in, and I think I showed there was a guy from the CME who's another wonderful trader. He's got a lot of books out, and he's like, "Oh, I never thought of it this way." And I said, "Okay, it was time for me to kind of chill." But I'm gonna tell you guys because a lot of you already know about it. I look at the alligators in the lake, and that's where your standard deviations are at, or whatnot. Your standard deviation curve. That big bell curve, and outside you have the wildebeest. Okay, Now, of course, or it could be wildebeest on the mountain and lions on the outsides, that are on those other standard deviations. So the thing is by looking at market profile, you're either the wildebeest or the alligator, or you're either the lion or the wildebeest, depending on how you look at it. So that'll tell you. That's just giving you a little hint, but there's a way you could look at on your chart, and you don't have to buy those expensive market profile packages. All you have to do is the simplest thing you have to do to your chart. It's so simple it hurts. I mean, it's like, folks. But I did it at one of these expos. I showed someone. He's like, man, why didn't I do that? And I said, man, every time it gets there, 60% of the time, what's going to happen? When you do this one thing, 60% of the time when the price gets there, it's going to do this one thing. 60% of the time it happens, and all you got to do is set your risk to reward ratio and just trade it. And just sit there and wait like you're an animal. Like whether you're a wildebeest trying to get something to drink or you're a hippopotamus trying to get rid of the alligators. It's so simple it hurts. But anyways, back to the momentum. I had to give you the preview because when you see it, you'll just be like, oh man, and because price will tell you everything. Okay, and I don't care if you're using an HFT system or an algo system, or if you're trading long-term charts. It doesn't matter what it is. So look at the momentum of this. Okay, nobody sold underneath this. They said at this point in time, I ain't selling nothing until somebody else comes in to sell it lower. I can't sell it any lower than this. So the next time that happened, that was this, right? Okay, and experienced traders know this. I mean, it's very simple. Look at this. What happened? The momentum is starting to shift, is it not? Of course it is, because look at the steepness. Okay, you're walking up these Great Wall stairs, and when I was talking about the Great Wall, you're walking up here, and you're like, by the time you get here, you're out of breath. You're like, man, why did I do this? It reminds me of a friend of mine that I took on the Great Wall, and he says, man, because he saw all the steps and how bad it was and the momentum of the stairs, he says, you really tested my friendship, but I'm glad you took me there and told me to do it because it's a once in a lifetime thing for him. But he had me laughing. He says, man, you don't realize how you tested my, because he's like, I couldn't make it up some of them stairs. He said when he saw the little children and the old ladies doing it, it was real easy for him to do it because he knew I was going to talk bad about him and say he punked out. But look at the momentum here. Is it easier to walk up this? I don't care how fit you are, as easy as it is to walk up these stairs. How about this momentum? And it's so simple. The method, like I said, the method I use, I don't have to put all these trend lines up here to find the momentum. Right here, I could tell within just two trend lines that I know exactly where I'm going to pick the top, okay, of the market. And like I said, you could use either two trend lines or a trend line and just a median line, and that's all you need. And you just sit there and wait, like if it's your setup, like this is what I use. It's my setup, and I say, hey, if this happens 80% or 90% of the time, and I was going back to charts, I mean, I don't even want to tell you how many decades I was going back and how many decades I was looking at points of like major crashes, like everything from the flash crash to the I was looking at of course '87. I was even going back to the high inflation rates of the '70s. I said I want to see, is there a similarity of buyers and sellers when a certain thing happens, and just going over decades and decades. I'm going over tick charts. I'm going over range bar charts, going over average true range bar charts, going over point and figure charts, going over line charts, going over every one of these had said the same thing. Okay, they all, time-based charts. I don't care what it was, area charts, dot charts. Everything is the same exact thing. Buyers have to sell in order to make money, and sellers have to buy to make money. And the momentum doesn't change. The mentality of the mentality of physics, or the physics of mentality did not change. Okay, you have the same processes in physics that you have in psychology as you see it. It's the same thing that happens on a price chart. Everything from velocity, everything from torque, everything from momentum, it's the same exact thing. So just by using this, okay, and this little, and I'm just showing you the difference in momentum. I'm not going to show you my setup because, like I said, it's my grail, and I ain't changing it for the world. It's just been too good for me for the last year, about a year and a half, and I can't change it for the world. Until something tells me to come in and change it, I ain't changing it for the world. You also have momentum in the other direction. Look at that momentum. Look at those stairs going down that hill. Would you like to ride a bike down that hill full speed, or would you like to ride it? It doesn't even matter whether it's full speed. Which hill do you want to ride the bike down? This is unless you're really into thrills, of course, that's going to get you down faster. But this is going to get you down probably safer. Unless you're an experienced bike. But it's just just the concept of momentum. And what I used is by using just like I said, simple trend lines. It's so simple it hurts. I mean, when you see it, this is how by using this concept, I was able to tell exactly where, when, and where Bollinger Bands where you would hit the top of Bollinger Bands. And I'm not going to say every time, but I'm going to say it's about as the percentages of this happening using this methodology, picking the tops and bottoms of Bollinger Band markets. It doesn't matter. Is about the same accuracy, or it happens about as statistical as someone blinking. Okay, I mean the methodology is the percentages happen about as much as people blink. So I mean, hey, I'm just like I said, it ain't no holy grail, but it's my grail, and I ain't changing it for the world. Anyways, Hotep, and I'll show you a little bit more later. Okay, here you go, real quick. Well, actually, it might not be quick. Um, One of the things that I like within when in the trading is basically I always say folks have to find their grail, not the holy grail, but their grail. Okay, this is what kind of helps develop the trading methodology. And as I always say, trading is 55% psychology, 45% money management, and 5%, of course, what I do, and that's system development. Very simple. This is just real simple concepts to over, under, enter whatever stand that you want. Is realize this much. It's not about being right. It's not about being a guru. It's just about making sure you make more money when you're right than you lose when you're wrong. That's as simple as it could be. What helps me develop trading methodologies and really get it down is looking at certain different concepts. The different concepts of course, a lot of folks like using indicators, i.e., moving averages or things like that. Some folks like to use, once in a while, I may look at a stochastic, but I only use it to see if my methodology holds up. But as in trading with it, indicators are training wheels. That's bottom line. Sooner or later, you're just going to have to, realize that you're on a bike. Okay, it's not about the training wheels. One of the things that you have to consider, one thing about indicators is think of it as a mirror. Think of it this way: you get to the store, you're out with your date or husband or wife or whatever, and you get to the restaurant. And what happens is, by the time you get to the restaurant, you notice you have this, a ridiculous stain on your clothes, right out in the front where everyone sees it. Well, the thing is, the mirror just indicated it. Now, it's a lagging indicator. You're not going to call the indicator back at home and say, "Oh, by the way, do I have a stain?" Um, the thing is they indicated, yes, of course you have the stain, but it had to look at it. It had to reflect that. So basically, all it is a reflection of price or what the price is doing. It doesn't matter what the indicator is, but it still is going to reflect that thing. So something happens, and then it says, "Oh, by the way, this happened," like a mirror. But it's not bad. I mean, you can trade with indicators, whatever. The bottom line, they indicate. Okay, so as long as that concept is there, it makes it a lot more simple to trade and do what you have to do. Um, let's real quick, we'll get into. No, I'm not going to show you any systems or anything because my systems are my grail. And I always tell folks, that what I have might not be. Here's a case in point. Somebody told me about Marischal and about how he was a mathematician and created and was able to look at and it was, I mean, this is like one of the best traders around, best currency traders that I know of, that as well as bonds, and was talking about how Marischal created and I looked at the Marischal system or look at the results, and of course it was the holy grail, for lack of a better term. What I did is a lot of folks, including him, said you'll never get it done. It's impossible. No one will ever do it. Well, here's the beauty of it. For myself, it works. What I do, okay, my methodology, I call it Zumbi, but using just two swings in the market, I could tell where the next swing is going to be. And we're talking about the percentage of accuracy is off the hook, ridiculously off the hook. So It's not like I mean, like I said, I won't call it the holy grail, but I'll call it my grail. What I do is I wait till the price gets there, and then I take divergence as my trigger. I have a very simple divergence methodology that looks at a certain thing in the market. Is no indicators. You don't need indicators to see divergence. It's a very simple method. You really don't need indicators to see anything if you don't want to. I mean, you can just simple price action alone will tell you where a moving average is going to cross or where it hits the Bollinger Bands, or I mean, you can look at a chart and see that that's what happened, or that's what's going to happen. That's even better. But yeah, the method that I use, I have to thank there's brother T. I have to thank him because he posted something on the site and says, "Does anyone know exactly how you can find the third point of any kind?" And I use action reaction, not the full pitchfork. I just use median lines. That's all I care about. By just doing this, I can tell where the separate points are going to be in the markets coming up. And of course, I ain't going to show it because it's my grill. But it just keep in mind, Marischal was a mathematician from what I believe. So I had to go back into my archives of college and high school, and it's not just simple math. Okay, this is some of the things I had to look at were just something that made sense. I'll just say when things make sense. That's when I trade, I like to trade what makes sense. That's all I care about. Does it make sense? Keep in mind, all you're looking at is buyers and sellers. Okay, that's all these things are. When it goes up, it's buyers. When it goes down, sellers, or less buyers. And when it goes up, more buyers, or and less sellers. You're looking at, of course, there's the Wyckoffean, and I can get into that a whole separate video. But a lot of folks are the Wyckoffean, folks that they start talking about, the Wyckoff had some, and of course the VSA folks like it, effort, result, supply and demand. Um, let's see, cause and effect. But there's three other concepts that folks didn't look at, and I know Brother A was, I used to teach this to folks. And these three other concepts, you have to look at it very holistically. I like to look at the animals on Discovery Channel, and that'll tell you. Because keep in mind, think of these as animals, okay? Those animals have different things, like the cheetah, for instance. And this is, if you look at what cheetahs do, you can tell what any Bollinger Band's ever going to do, or any standard deviation channel, or Keltner bands, or anything. Just watch cheetahs. When you want to see moving averages, look at herd animals like wildebeest and alligators. And when they get, and I'll get to that concept later. But this kind of helped me out when I watch animals. Like I look at dolphins. Like if I want to see where market turns are going to be, I look at fish, because you have to the same concepts that animals do, people and machines that people program do. Feast or famine, okay, greed and fear. Just the very simple concepts. When you watch that in animals, you see it in people. You see it. Case in point, look at some of the videos of the Black Friday, or the videos of all those folks trying to buy Jordan retros. That's exactly the same concept. Or the sitcoms where they show the women shopping, and all of a sudden, I mean, just watch that and you'll see exactly the same mentality over and over, and you can just see it in the markets. You can see it so simple. So what happened is I developed my own methodology of how to look at that. When I saw how to look at that, I just set up my trend lines, wait for the divergence to come in, and like I said, once I see the divergence, that means something is not happening with something else. They're not going in the same way. They're going in different ways. Thus, I know that whoever wins, and again, like I said, it was I had to go into a little bit heavier than just simple math. I mean, there was some things that I looked at and I said, oh, and it's very natural, because it happens in nature all the time. Okay, these concepts happen everywhere in nature. It happened in thunderstorms. They happen when plants grow. They happen with. It doesn't matter what nature has this all the time, every time. Even people's arguments, you name it. Giving birth, you name it. It happens over and over. So I was able to see that in markets, and that's how I trade. And so far, I won't change this methodology ever. It's just too. I love it too much. I am not going to change this, and I can't give it away, but I could just give you some ideas to kind of help you develop your own. I can never give this away. It's just too important. Um, but the thing is this is what I love to use. I love to use just median lines, and just by using the median line, you could tell where the next few points in the market will be, no matter where you put that median line. I don't care where it's at. I'll put it anywhere, and I use just some math, and next thing it'll be like, oh wow, and it's not just where and price the market will go, but also where in time with a phenomenal accuracy. And if I get one point in time later on, that's all I care about. But if I can get several, I'll just set those points up. I'll put my little dots up there, and then I'll just wait for the divergence. And we're talking extremely high probability. I mean, we're talking so accurate it's sick. But anyways, back to the animals. Think of this as a stream. Okay, that's all it is. This moving average is nothing but a stream. Or like I tell people, they're like a kiosk at a store. Okay, at a mall. Now the kiosk is very dynamic. It can be kind of temporary, but it's very dynamic. People go and then they move to another place. They go and then move to. So of course, that's all these are is kiosks. Now, think of the trend lines as the stores. These are actual stores. Okay, these trend lines are, if it breaks a trend line, think of this, all the overhead that a store actually has, a storefront has in a mall. Think of the insurance they have to have. Think of the fact that they have to have bigger advertisement. They have to trend lines have to be advertised. Everything has to it takes a lot more to get to when it breaks one of these. Then hey, the market is because it's not like a kiosk. It just moves and moves. But when it breaks this, like the store, you can't just pick up a store and move it from one place to the next as easy as you can move a kiosk. So it's like, so that's how I look at certain aspects. So I had to develop my trading system by looking at it this way. Now think of these moving averages, like those who like to trade, and it's fun because here's the thing: I can tell where moving averages are gonna cross almost high 90% of the time just by setting up my trend lines, my stores. Because if I have my storefront and I have a guy who's a storefront across from me, and we're both selling the same thing, or say we're competing, and he's buying and I'm selling or whatnot, or he's selling better product, or a lot durable goods for lack of a better product. He's selling washing machines or whatever, and I might be selling blenders and something smaller, but maybe we have the same kind of thing. We can tell by how our sales move or don't move, or if I'm selling faster than him or whatnot. We could tell if the kiosk is going to stay or is it up or it's going to move somewhere else. We can tell because we are the storefronts, whereas the kiosk. So this kind of gave me the idea of saying, how can I use trend lines to tell almost all the time where a moving average will cross? I don't care what the moving average is, where because keep in mind, moving averages, or say you got like 7 out of 10 people doing something, or 3 out of 10 or 5 out of 10, you get that average. You'll say, oh, okay. Think of it like this way. I always tell people about like cats in a bag. When they ask me what's the difference between stocks and ETFs, I say think of stocks being an individual cat. Trying to herd them together is kind of hard. Think of an ETF as cats in a bag. Think of a moving average is in a bag. Okay, the average is moving. Therefore the consensus is moving. These, instead of folks moving all individually, they're in a bag, and whoever's the strongest, or however many are the strongest, are going to move it wherever it needs to get. So therefore, that moving average is going to give you the majority, or where folks want to go. So you're looking at this. Think of this as water. That's all a moving average is water, like a stream or something of that nature. If you're over it, you're meat eaters. If you're under it, you're vegetarians. Sooner or later, all animals have to drink water. I don't care what it is. Price will always get to its moving average sooner or later. Someday, it might be a million years from now, it might be 1 minute from now, but sooner or later, because buyers, in order for buyers to get paid, they have to sell. In order for sellers to get paid, they have to buy. If there was any other way around it, hey, cool. But sooner or later, everybody has to drink water to get paid. Okay, to square up or to close out a trade. So the thing is by looking at that, when I saw the vegetarian, I used to teach this all the time. The vegetarians say, everybody got to the water hole, and then keep in mind, at the water hole, you're at the risk of getting devoured or going hungry. Okay, that's the greatest risk you have when you're at the water hole, or when you're at the stream. Because if you look at these vegetarians are going back to the stream, well, now the meat eaters must have eaten some vegetarians because now they're buyers. Now all of a sudden it goes back to the stream, and maybe they missed a few because they're sellers. So the thing is once the vegetarians have eaten, or no, I mean once they drank their water, well, they're a little hungry right here. Now they're going, they're hungry, and not enough meat eaters are catching those vegetarians. Now they get back to the stream to drink some more. Meat eaters couldn't, they weren't hungry enough, so they let the wildebeest fatten up a little more. Like I said, I watch a lot of Discovery and a lot of herd mentality or school mentality. When I'm watching a pride mentality or a gaggle of geese or whatever, just to see what happens in feast or famine, flight or fright, or fight or flight. You can see that people have the same tendencies. Like I said, you see things naturally in everything. So right here, look at down here. You see all of a sudden, the vegetarians have eaten a lot, so they go to the hole, the watering hole, and now all of a sudden they've eaten, so they don't need to. So now the meat eaters are eating those vegetarians. That's why you see buyers. So by looking at this, I was able to develop a system, a methodology, for lack of a better term, where I say, okay, here's my risk and my reward. This is, again, no matter what you do, even if you have only win 3 out of 10 trades, just make sure you make more money out of those 3 than you do losing those other 7. Okay, it's that simple. Whatever methodology you use, and then that takes a lot of the psychological aspect out, because you're saying statistically this is how it is. So you take 1,000 trades, that like if you have a 10 to 1 reward to risk ratio, you win 10 for every 1 you lose. I mean, excuse me, you win 1 for every 10 you lose. Then you win 3 out of 10, you're still going to make money. Okay, if because I mean, if for you 3, and maybe you've lost 21, but that 1 pays for 10. So it's like it's like I mean it's basically or excuse me, I'm messing up my math, my bad. But say for instance you lose, you lose 10, I mean you lose 7, and you make 3. But if those 3 right there are that you've made 30, just for those 3, because you have a 10 to 1 risk reward ratio, you're gonna make money. Okay, I mean it's real simple. I a lot of times, here's one of the easiest things, because I'm very dyslexic right now, so I'm gonna show you the easiest way that I set up risk reward ratio. Is I'll put a trend line right here, and it doesn't matter whether it's a moving average. Say if I'm just saying, because I don't use indicators unless it's very rare. I use like a stochastic just to see if my methodology holds up. But this is something that I taught folks a long, long time ago. The simplest way to look for your risk reward. If you think that this might hit this level of support down here, or where the meteors and vegetarians changed hands, or right here, look at the last time they changed hands, and then just go from there, and just go in and let's see. I think this. Let's see. Let me copy this. I think I can copy it. Say for instance, you say, okay, the next time that I know that this is where I want to get to, because I want to short the market, or I want to go ahead and sell the market. Well, this right here, that's 1. So let's go ahead and paste 1 over here. So we know that it's going to take 1 right here. Let's paste another 1. And right here. So you say, all right, at the break of that trend line, if it breaks right down there, I'm going to go ahead and sell when it breaks here, or maybe when it breaks here. If it breaks down here, that okay, that's 1. So that's your risk right there, that that if it goes over that trend line, you're out of the market. That's a losing trade. But you say, I want to get down to here. Well, look, you have 1 and maybe a third, 1 and a third. So you're losing 1 to make 1 and a third. It's like one of the simplest ways, because once you have a target in mind and you say, oh, okay, well, if this is my risk, if it breaks here, that's my risk. I'm willing to risk this, if in case the market goes back up, in order to make this. And it just it takes a lot of the mental aspect. But I used to do that a lot of time with trend lines, because sometimes folks get really, really analytical, and they don't realize that trading is just about, it's not about being right. It's just about your risk reward and just being very consistent. Just do the same thing over and over and over and over again. Because I mean, think of it this way: animals have a setup. Lions, when you watch Discovery Channel or anything else, they don't just go in and just, I'm gonna just grab that wildebeest or grab that zebra, because they know they have a risk of getting kicked, or say it's alligators. They have the risk of getting trampled by wildebeest or whatever. So they have a setup. They wait for a certain thing to happen that they know has happened since the dawn of time. and they just wait for it and they wait for it, and then all of a sudden, when that condition is right, they go and they eat. They go and they attack and they eat, and that's what you watch a cheetah. It has a setup that it usually does. It says, okay, I'm gonna wait for this certain condition to happen. Boom, I'm gonna have it, and that's what I look for when I develop Zumbi. And I mean, like I say, it's so predictive it hurts. Like you can use these system or methodology to tell exactly where the Bollinger Bands are gonna break, and therefore the trend is gonna go the other direction. Again, watch cheetahs if you really want to see that, because they typify how a Bollinger Band works. When it reaches that standard deviation, or that those outer regions of those deviations, and it has to come back. Watching a cheetah is one of the best things to do. If you want to see how, I mean, I'll get to that later. I mean, just like I said, I watch a lot. Like watching fish could tell you where market's going to turn just by looking at the reaction. Like if you watch schools of fish. I was at the beach one day and I was watching seagulls, and seagulls will really show you where like, because for instance, throw a bunch of food down, and seagulls will show you where opportunists are at. Okay, they'll show you. It's almost like market makers. Okay, don't throw popcorn down or something. I was over at the beach and I was watching this. I saw this brother just throw down a bunch of potato chips or something like that, and there were a lot of seagulls, but they were all doing their own thing. And as soon as he did, you saw the opportunity, and then you saw the other ones going, and it was almost like watching a news event, and see exactly what's going to happen at that news event and how to trade it, And so these are just, but it's how to develop a methodology around it. But let's get back to these other animals. Meat eaters here, vegetarians are shorter. So all of a sudden, the meat eaters they were too full, so they decided to go drink some water. They went to a stream. Now, one thing about moving averages, and what kind of helped me develop the methodologies that I use, think of the smaller term moving average is a smaller river or a small creek or something of that nature, and think of the larger moving average. Think of a larger one as being like a river. These smaller ones just maybe little tributaries or whatnot. The larger moving averages are actual rivers. Those are the big. So when you start looking at this, you'll start to be able to make money a lot more consistent. And irrespective of whatever news event comes out, because a lot of times folks look at the news events and they're like, "Oh, it has." I could care less about news. Okay, I really don't care. All I care about is what's happening, and is my setup like an animal. You know, am I ready to eat wildebeest, or am I ready to eat grass? I mean, that's all I care about. Let me just do this so I can make the river a lot thicker. Okay, the heavy blue moving average. Think of that as a major river, and the smaller one as just like the tributaries or small creek. And this is what kind of helped me find exactly, just by using a series of trend lines, almost all the time where moving averages are gonna cross. You can almost tell, boom, they're gonna cross right here. They're gonna cross right here. I don't care what moving average you have. The markets are fractal. Okay, they're very fractal. Anytime this trend line breaks at a certain time, or these two trend lines, you're going to see there's a moving average cross that encapsulate those market waves that happen within that. Like for instance, you have certain market waves that happen over and under a trend line, or over and under moving average, or under. It doesn't matter. This will tell you, hey, by putting these two things up, you'll almost be able to tell right away. Oh, there's a moving average break, and when you see it and put the moving averages there, they'll almost mirror the trend lines. I mean, it's we'll get to that another day, but I love it. Again, like I said, I really don't care about the moving averages because they're kiosks. They're after the fact. But when the thing I like about using my trend lines is they're, like I said, a store has more overhead, so it just kind of helps a little better, so that way I don't have to wait for it to cross. I see it happen before the indicator actually, or the thing that indicates actually does. But that's a different thing. Think of this moving average is the Nile. There it is. It's a bigger river. Okay, much bigger, or the Amazon. So therefore, when you see these animals go over the bigger rivers, to go from drinking, they've feasted and now they have to get some water. That means that there's a massive herd. There's a bigger herd. There's a lot more. There's a lot more water. That means there's a lot more importance on it before they go to the dry season or wet season, whatever happens. So that's why you see on bigger averages. Of course, you're going to see bigger moves. Smaller averages, of course, smaller moves, because smaller animals will get to their butt. They'll get it first. Okay, the smaller average will react first because it's going either into or out of a bigger river. Okay, it's like a creek. Okay, you follow the creek, sooner or later you're going to get to the giant river. Okay, or if is you leave the river, you're going to get to smaller creeks, but the creeks will act first, and you'll be able to you smell the creek and you get close to hey, that smells like there's some water around. You follow it enough, you're going to get to something bigger. Okay, and that's literally by looking at this. I'll get to the actual methodology one day of how to do it, but my favorite, and again, like I said, I've been having so much fun trading. I don't care losses and all because I do have losses. Again, I have to have losses so I know exactly what my risk to reward ratio will be. Without that, I can't tell how to develop my system. If I have like a one winner and 9 losers, then I can say, okay, let me develop a methodology that for that one winner it pays me 30, for what 30 losers would pay. And it's very simple, but by just using this, just a simple trend, just a simple median line, and a couple other mathematical concepts. I can't share it right now, but just by using that, you can almost tell with the utmost accuracy that this is going to reach this point and time. It's going to reach this point and time, and where the market will fall off and reach these at their point in time. Very simple. But I have to thank Brother T. I love when folks give me missions. Like I have to thank Brother T, and I have to thank like I said, this trader. He's like the number one currency bond trader. Who's deeply in. I mean, he's what gave the idea of action reaction to me. Even though those concepts go back to ancient Africa, ancient African ancestors said, "As above, so below." So he had brought it. This currency trader, bond trader, brought it. Of course, he believes in Archimedes and everything else, and gave me. And I have to thank him. I have to say, "Oh, you gave me a mission when you said what can't be done." Okay, I mean, right now I'm not trading any other method, and I don't care if you're using range bars. I don't care if you're using again. I don't care. A lot of times people will have bullish and bearish bars. I could care less about that. All I want to do is see the certain thing condition happen in the market, and I can actually project in the future with. I won't say it happens every time, but it happens about as often as one gets up in the morning. Okay, so as one goes to sleep every night. Okay, that's how often it happens. So I mean, it's my methodology, it's my grill, but I just had to put this together because I'm gonna start just giving subtle hints. One of my channels got hacked, so so I can't put it on my norm. But just some ideas.